Let's go.
Okay. Well, good morning, everybody. Thank you for being here. We're really excited to present. We introduced ourselves earlier, but I'm Matt Lambert. This is Cameron Knaps and Mac Fountain, and we're going to tell you a little bit about Rock 10 today. We're from the University of Alabama. So we'll get going. A little bit of background on the company. The company is North America's second largest paper packaging company. As far as publicly traded ones go, Georgia Pacific is also a big player. It's headquartered in Norcross, Georgia, which is actually a short drive from where we are today. Employs about 26,000 people and was founded in 1936. The company recently bought Smurfit Stone in a leveraged buyout for $3.5 billion. And that's been a huge acquisition for the company and a big reason why we are a buy. So a little bit about our investment rationale. Our price target is $93.50 based on a discounted cash flow model that we'll get into later. Leaves us a margin of safety with only 8% right now. Since we started researching the company has had a tremendous increase in share price, and so that has really eaten into our margin of safety, but we still really like what the company is doing. Basically, we believe that the market has been discounting the Smurfit Stone acquisition and the management's ability to bring that through to where they want it to be. We think the synergies are going to be tremendous the way that management is projecting, and that's the biggest reason we like the company. A little bit about that management I mentioned. James Rubright and Steve Voorhees have done a tremendous job in the past with their acquisitions of both Gulf States and Southern Container, and the share price, as we'll show you later, has really increased after those acquisitions, and we believe that Smurfit Stone is going to be the exact same case, and they've proved that they can do these types of acquisitions and be successful with them. So here's just some metrics showing you how Rock 10 does compared to its competitors. International Paper is obviously the big player in the industry. Rock 10 second biggest by market cap. Put Georgia Pacific up there. As we mentioned, they're privately held. But margins are in line with most of the other competitors, as you can see. The business segments are as follows. Corrugated packaging is 66%. Smurfit Stone's really increased that as a percentage of sales. And 27% is made up of consumer packaging, which is what we see more often, obviously cereal boxes, that type of thing. And then recycling makes up 7% of their sales, and recycling is a big part of their business as far as providing inputs for the previous two segments. Here's a couple of graphics showing you how their revenues have changed as a percentage by product. Since the Smurfit Stone acquisition, Smurfit Stone has really increased their corrugated packaging segment, as we'll show a little bit later in more detail, but that's been the main driver in the changes percentages go. And here's showing you kind of what revenues have done since the 2011 acquisition. They've tripled because Smurfit Stone was such a large company relative to Rock 10's previous size.
All right, in 2011, Rock 10 acquired Smurfit Stone for $3.5 billion, gave them 25% of the containerboard industry. They expect to achieve a run rate of $550 million of synergies from this acquisition. So far, they've achieved $325 million of that as of first quarter 2013. And the capital to reach this run rate and the time has all been extended, and it's more capital than they thought. So it's not going as well as they originally believed, but we believe they're on track, and we'll get it done. These are two slides basically showing where exactly the synergies have come from. Mostly they're from closing inefficient plants, improving efficiency in some mills, and administrative and such upgrades. This is a 5 forces analysis. Basically, their biggest weakness right now is intensity of industry competition. Biggest strength there is probably their management. Basically, they've integrated 2 big acquisitions in the past successfully, and they also, and historically, have had the highest margins in the paper business. Further, they're safe from international competition due to the low value to weight ratio of paper, which makes it just the cost not justifiable for international competition. Pension funding, they have a $1.5 billion pension obligation, of which $400 million of free cash flow will go towards this year. They're going to continue to pay that off until it's fully funded. Also, there's intense industry competition because there are many different competitors and not much product differentiation. Right now they're trying to deleverage. They're at 2.7 times debt over EBITDA. Their target is 2 times debt over EBITDA. Once they reach that, they can have dividends, they can have a higher dividend, share buyback, possibly another acquisition. Their target for that is fiscal year 2014. Also, the industry is consolidating with International Paper's acquisition and Rock-Ten's. And so basically they have more pricing power. Late last year, they sent through a price increase, and they should have more in the future. The biggest threat right now is the acquisition and integration of it. They've already taken back the timetable and more capital, and they could continue to do that, but we believe because of their management and their history that they will get the acquisition done. But that's definitely their biggest threat right now. This is the chart showing the share price since January 2012. Obviously, past few months it's had a big jump, but even this past week it's gone up considerably. Shows their 5-year relative performance. They've outperformed their peers, Clearwater, National Paper, etc. They've outperformed the S&P 500. They're doing very well right now.
So this is the core of our analysis. It's the really exciting part of the presentation, the financial analysis. Basically, we didn't want to value the company based on what it's producing now. We wanted to look at its future estimates, and this was particularly important when creating a discounted cash flow model. So this is kind of summary measures, but basically what we did was we broke the company out and looked at each of its segments, projected forward revenues, projected forward income based on margins, income tax based on tax rate, so forth, came up with these estimates for free cash flow. We would like to point out that they're right in line with analyst and management guidance. Management's investor presentation yesterday actually predicted free cash flow for 2014 of between $750 and $822 million. We've estimated 783, a little bit on the low end. We think it's a conservative value, and we're right in line there. So based on that, and based on a discount rate of 9% and a long-term growth rate of 2.5%, we think that Rock-Ten has a fair value of $93.50 roughly, which gives it about an 8% margin of safety. The long-term growth rate basically, I guess, stipulates that Rock-Ten will be able to pass on the costs of inflation to its consumers, but won't necessarily grow all that much. And the discount rate is based off the weighted average cost of capital, and we actually added in a little bit of a premium there because of the current low cost of debt. We can get into how that's calculated more later if you have any questions. Can you go back just a second? We'd also like to point out that we have a contingency table to basically show what changing the discount rate or the growth rate would do to share price. So a couple more notes on valuation. Historical value metrics. This is price overlaid with earnings per share and 200-day moving average. You can see Rock-Ten is trading above both of those measures, so it's trading at a premium to historical valuations. Flip to the next one. This is enterprise value over EBITDA. You see the same thing, but it's a slightly tighter margin. This graph is also useful because it shows what the Smurfit Stone acquisition did to both enterprise value and EBITDA. And if you look at these two measures, you can see that I guess it is trading at a high valuation compared to the past, but we think this is entirely justified based on the increased earnings it should get as a result of the smooth integration of Smurfit Stone. Its margins will increase, and it will have a corresponding increase in earnings. So it should be growing at a faster rate than in the past. So I guess final comment on the valuation. The DCF is our preferred model because it gives you the best measure of fair value, but even when looking at past multiples, we find that Rock-Ten is fairly valued. So basically, to summarize, we were initially a strong buy on the stock. Because of recent appreciation, we would say we're more of a hold at this point with only an 8% margin of safety. We think it has plenty of room for growth. Management has done an excellent job integrating past acquisitions and should be able to I guess, bring the Smurfit Stone acquisition in and really take advantage of synergies there. So, any questions?
First, you all said that you mentioned their prior success in acquisitions, making acquisitions. I'm not familiar with the acquisitions they've made in the past, and could you just provide a little? Is this acquisition they're making a lot larger than the acquisition they made in the past, and how would that affect things?
It's definitely a lot larger. In the past, they had two mid-size, I'm not sure exactly how big, but mid-size acquisitions. And basically, they've had a little trouble with this one. That's basically our thesis is why the stock price was deflated. But they seem to have a handle on it now. And basically, it was just too smaller size. But they were large enough to prepare them for this, essentially. They swallowed a fish bigger than them in Smurfit, and they seem to have a good handle on it. It's just a little worse than they thought originally.
Who gave the presentation on the Porter 5 forces? I mean, you sort of like got the page up there and the cool spider web. Could you go back to that?
Do it quick.
Sure.
This is a metric that or not a metric, a way of looking at companies that we were not familiar with before doing this analysis. Basically, 1 would be least favorable to Rock 10, and 4 would be most favorable. As you can see there, we've got 2 on.
Say that again. So 4 would be most favorable.
Right.
So their favorite threat of new entrants, not too much of a threat. Substitute products, average. Bargaining power, average.
Correct.
Bargaining power with suppliers, average. Intensity of competition, bad.
Correct. Because there's so many different just competition companies. So
And low product differentiation is probably the main reason for when you make paper packaging products, you don't really make a way better product than another company.
exactly.
The one bright side is the high costs or barriers to entry that gives them less threat of new entrants.
So the big thing is customer satisfaction. And they had this presentation yesterday, and their customer satisfaction is over 90%, and that's the big differentiator between these companies.
So this won't go to any of your grades, I swear to God. Anyways, how many of you watched the entire 3-hour presentation yesterday?
He was going to.
he was gonna fall asleep to it, but
I was going to let it.
Well, you watch it tomorrow instead of doing something else.
We looked at the slides.
yeah, absolutely.
I did too. I looked at the slides very quickly.
There were a lot of them.
A lot of your forward assumptions seem to be based on a high impression of management. Has there been management turnover since the acquisition?
I haven't seen any like that now.
I know Voorhees was
Yeah.
after the acquisition moved upwards.
Yeah.
But as far as I know, there hasn't been major turnover as far as people leaving.
Yeah.
CEO's the same.
And I don't know the answer to this, but was there any acrimony in when they acquired Smurfit Stone, and maybe they made promises to their management that didn't actually come to be?
I don't know exactly on that. I know that they have been replacing a lot of their management team because, I mean, as far as I
Smurfit
understand,
people?
Yeah, as far as I understand, Smurfit was not ran that well, and so
Mhm.
they're replacing them, and I'm sure there's been a little turmoil there. I haven't heard anything upper level, but I mean that may be going on. I know on a more micro level.
Right.
Yeah.
Right.
I mean, there's always going to be a little bit of dissension when you're closing factories and
Yeah, exactly.
consolidating all that as
Yeah.
well.
The DCF was your biggest valuation point. Can you go back to that slide? What I'd like to, no, one more slide back. Yeah, that slide. It appears that free cash flow has been shrinking every year since '09.
Yes.
And then you've got an assumption in 2013 that is, an enormous jump from 2012 and then growing from there. So could you explain how you come up with that assumption and, Because, obviously that's going to have a major impact on your valuation.
Definitely. Well, when you first look at it, it does look kind of staggering. This is actually based almost entirely off of management guidance. What we did was we projected revenues for each segment, so we were able to break out which segments were growing more quickly. Then we projected based on margins. We were able to project operating income. We took the margins from the most recent quarter and kind of looked and tried to figure out quarterly trends and all that. Looked a little bit at management guidance because they did recently have the price increase, $50 price increase. So we were able to take that and basically look and come up with net income and from there subtract out to get operating cash flow and obviously work your way down the financial statements to free cash flow. And this number may seem high, but each of the, bottom line estimates, net income, capital expenditures, free cash flow, are right in line with management guidance, and they're right in line with analyst expectations more generally. So it seems dramatic. We think a lot of this, A, it's a much larger company now that it acquired Smurfit Stone, and B, the last couple of years have been kind of rough as they took a company that was a failed company, do all that, bring it up to stuff where their historical performance and get margins back.
Historically, how accurate has management's guidance been in the past?
Honestly, not entirely sure. We did go towards the end of management guidance. Pointed out they had between 750 and 822 million in free cash flow, and that was assuming zero growth. That was just assuming increase in margins. We think they're allowed to have at least a little bit of growth, and we still projected at the bottom range of that. I guess one of the concerns in the past has been that they guided, guided would be the word, suggested that the integration of Smurfit Stone was going to go more smoothly than it did, and we kind of took that into account. If you see here, margins increased a little bit from 2014 to 2015. The company thinks that it finish its integration and realize the synergies by the end of 2014. We're a little bit skeptical that will actually happen, so we have a slight increase in 2015 and have 2014 fall down a little bit. So.
Seems to be the deal is realizing synergies. They promised $550 million when they made the acquisition. Can you go to that slide? Which is actually quite a slide. So where I'm trouble?
Hodge Mill typically is the one you hear about.
That's actually, well, I didn't anyway, I'm not supposed to have done that.
It's a good thing.
No, what is that? Where is it? What particularly about that? Is it?
Like a upgrading there. It's not as efficient as I thought it would have been based on their upgrades, and maybe they're doing more upgrades than they originally needed to reach that efficiency. I think that's the crux of the problem. And the real question is just how much capital is it going to take out, because obviously free cash flow is king here, and they need as much as possible because they have a pension obligation too. And so it's more of a short-term worry, and over the longer term, it's not really going to affect that much. And that's kind of our opinion, and it seems to be the market's opinion.
Could they nuke it? If they could get rid of it, could they just close it down?
I think it's
more cost effective not to.
Yeah.
They close in
it's not expensive.
Can
You talked about valuation and
Trim.
Come on.
I would love to answer the question.
Okay, I was just curious, you all looked at the, or I think I heard someone mention relative valuation and an average where they were trading based on price to earnings multiple average.
Yes.
How would the acquisition, that 5-year average doesn't include part of it doesn't include the acquisition.
Yeah.
How would that acquisition affect that multiple?
Well, that was kind of an interesting question for me. Can you do the enterprise value to EBITDA? This is really interesting to me because obviously when they did the acquisition, they took on a lot of debt. So you see the enterprise value jump up, but it's in a similar range all the way around. You see the price is lower compared to the EBITDA, or I guess enterprise value is lower compared to the EBITDA, and you see the same thing for the price to earnings. I think that's as much a product of the time frame and the macroeconomic conditions as it is of the pre and post acquisition. Because, I mean, obviously pre-acquisition tells a different story, but you look at it at the same time, in 2009, 2010, the market was trading at a significantly depressed level from where it is today. So.